Your life savings vanish in 4 minutes unless you spot the flaw in this algorithm. You are staring at three flickering monitors at 5:47 a.m., surrounded by lukewarm coffee and red tide stock charts showing impossible double-digit gains. It looks like a gold mine, but the pattern hidden in the dividend yield is a predatory trap designed to bleed retail investors dry. The market is opening, and you are currently being hunted by a machine. A high yield is a signal of health. They look at a 10% yield and imagine their bank account swelling. They do not look at the underlying equity. They do not calculate the payout ratio. They assume the market is generous. The market is never generous. The market is merely an accounting machine. When you see a stock yielding 12%, you are not looking at a bargain. You are looking at a distress signal. Think back to your first year in finance. You sat in a cubicle. Your manager dropped a stack of SEC filings on your desk. You were told to calculate the coverage ratio for a retail firm. They were paying out 95% of their earnings in dividends. The share price was collapsing. Every analyst in the room knew the dividend was going to be cut. Every retail investor was buying because the yield looked attractive. You watch the trap snapshot. The first rule of dividend investing is simple. Yield is a fraction. It is the annual dividend per share divided by the stock price. If the dividend stays the same and the price drops, the yield rises. A high yield is often just a broken stock price. When the share price is down 60%, the yield math starts to look absurd. That is when the amateurs rush in. They mistake a sinking ship for a fountain of gold. Consider the case of the telecom giants. In October 12, 2022, investors were chasing massive yields. They were ignoring the debt load. They were ignoring the capital intensity of the business. You watched the stock trade at record lows while the yield climbed above 8%. The balance sheet was screaming for a reduction. The management kept paying. The investors kept cheering. Then the inevitable announcement arrives. The dividend is cut in half. The stock drops another 20%. The yield is no longer high. The value is just gone. You have to look at the payout ratio. That is your primary filter. A company that pays out 30% of its earnings has room to breathe. It has capital to reinvest. It has a buffer for a bad quarter. A company paying out 100% of its earnings has no room for error. One bad contract, one supply chain disruption, one legislative change, and the dividend evaporates. You are not investing in income at that point. You are gambling on survival. Let us talk about leverage. Debt is a double-edged sword. It looks great when the cost of capital is low. It looks like a guillotine when interest rates rise. You have seen companies with high yields and high debt profiles during the cycle of 2022 to 2024. As the Federal Reserve pushed rates higher, those interest payments exploded. The cash flow that was earmarked for shareholders was suddenly diverted to lenders. The dividend is always the last expense to be paid, but it is the first one to be sacrificed. Your job is to identify the difference between a cyclical downturn and a secular decline. A company in a cyclical business might cut its dividend during a recession to preserve its rating. That is a strategic decision. You can respect that. You can even buy the dip. But a company in secular decline is a different animal. A newspaper publisher or a dying retail chain offering a 12% yield is not a value play. It is a slow motion liquidation. You need to know which one you are holding. You check the EBITDA margins again. You see the trend lines. They are moving downward. The dividend yield is moving upward. This is the inverse correlation of doom. The market is telling you exactly what it thinks of the company's future prospects. It is telling you that the dividend is unsustainable. It is telling you that the risk of capital loss outweighs the reward of income. You do not argue with the market. You listen to it. Do you remember the energy sector in 2015? Oil prices were in free fall. Investors were yield trapped. They bought into high-yielding energy MLPs, thinking the dividends were safe. They didn't account for the spot price of crude. They didn't account for the leverage within the pipelines. When the cuts came, they were swift. The dividend yields were decimated. Many of those stocks never recovered their former glory. It was a lesson written in blood and red ink. The second rule of the game is proximity to the cash flow. You need companies with strong, growing free cash flow, not accounting earnings. Cash. Real money hitting the balance sheet. If the free cash flow is not covering the dividend by at least 2 times, you are dancing on a razor's edge. You look for companies that raise their dividends every year for a decade or more. That is your margin of safety. That is your proof of fiscal discipline. You think about the people who call you for advice. They want the yield. They want the safety. They define safety as a high, consistent payout. They don't understand that the highest payouts are the most volatile instruments in the market. They are looking for a place to park their wealth, and they keep choosing the most dangerous neighborhood in the city. You don't tell them they are wrong. You show them the data. You show them the dividend history of companies that collapsed. The trap is not just the yield. The trap is the psychological anchor. Once you own a stock for the income, you start making excuses for the company. You ignore the declining sales. You ignore the executive turnover. You ignore the negative headlines because you are looking at that quarterly deposit. You have been bribed into complacency. That is when you are at your most vulnerable. That is when you lose your capital. You stare at the screen. You are watching a real estate investment trust yielding 15%. It looks tempting. It looks like a mistake waiting to happen. You check their occupancy rates. They are falling. You check their loan to value ratio. It is at 80%. They are leveraged to the hilt. They are using debt to fund the dividend to keep the share price propped up. It is a Ponzi like structure within a legal framework. You click away from the ticker. You do not touch it. Your process is simple now. You screen for dividend growth. You screen for payout ratios under 50%. You screen for net debt to EBITDA under 3. If a stock doesn't meet those criteria, it does not exist for you. It doesn't matter how high the yield is. It doesn't matter how popular it is on social media. You ignore the noise. You follow the math. The market opens. The volume spikes. You see the high yield names getting hammered as traders react to the latest CPI print. It is a bloodbath for the yield chasers. You feel nothing. You're holding companies that grew their dividends during the pandemic. You're holding companies that have no debt. Your portfolio is quiet. Your portfolio is boring. Boredom is the ultimate edge in this business. If you want to understand how the machines are built, you look at the fundamentals. You look past the shiny numbers. You ignore the siren song of the double-digit yield. You focus on the quality of the earnings. You focus on the strength of the balance sheet. You stop playing the lottery and start playing the long game. You stay consistent. You stay disciplined. You stay in the market. If you want to see how the analysis is done, you know what to do.